This is Peter Schiff here at SchiffRadio.com. Anyway, I wanted to open the hour by continuing on my discussion of yesterday of Porter Stansberry's claims to have predicted the financial crisis. He's got a YouTube video out there, Porter Stansberry Research, The End of America, that has been viewed by almost 540,000 people. Now, there are no comments because the comments have been disabled, which is generally a sign that they don't want people debunking these false claims in the comments section. The video has been heavily advertised on radio and television. In fact, it's advertised on this network. In fact, the commercial is voiced by Alex Jones. And Porter is trying to claim credit for having predicted the financial crisis of 2008. He says that he doesn't know of any other firm that more accurately forecast or warned about the 2008 financial crisis than his firm, Stansberry Research. He claims that he warned that the crisis was coming, that he told his clients to avoid a whole host of stocks, including a lot of the financial companies that failed, that he even positioned his clients to profit from the financial crisis by shorting stocks. And while there is a modicum of truth in that statement, and I will get into what little grains of truth actually do exist, by and large, it's false. I contacted Stansberry Research, and I asked them for any proof that they could give me to back up Porter's claims. And the only thing that they would do, and I appreciate what they did, is they gave me a password to their newsletter site so that I can go back and look at all of the newsletters that Porter Stansberry had written. Well, I have read now all of the newsletters that Porter wrote and sent out to his clients, and I can say in no uncertain terms that there is nothing in there that indicates that Porter Stansberry saw this crisis coming, even when he was right on the cusp of it. Now, in 2006, there wasn't a single article that he wrote that was warning about anything negative. Nothing. I'll give you a typical example of a newsletter from 2006. It was July of 2006. It was titled, "The Best Opportunity You'll Ever Have with Blue Chip Stocks is Right Now." Quote, "I want to be crystal clear about this. In 5 years' time, 10 years' time, you will look back on these days and shake your head in disbelief that you could have bought stocks like Intel, Microsoft, Johnson & Johnson, Nokia, Anheuser-Busch, Raytheon on Verizon, just to name a few, at the low multiples of earnings and cash flows that you have today." So here, the Dow's around 11,000. It's 2006, mid-2006, and he's talking about the greatest opportunity ever to buy blue chip stocks. Doesn't sound like a guy who's running around in 2006 warning about an imminent financial crisis and getting laughed at like he claims. Anyway, let's take a look at 2007. Again, nothing in 2007. In none of the newsletters. Every month, he's got 12 letters. Not a single letter is warning about any problems looming on the horizon. An example, in June of 2007, he has a newsletter titled, "The Safest Way to Grow Wealthy in America." Quote, "This month, I'll show you a total safe way to double your money, or even a lot more, next year by simply understanding the economics of our political system." Then he goes on to make the following stock recommendations in that newsletter: Duke Energy, Nokia, eBay, Anheuser-Busch, Harley-Davidson, and Verizon. Doesn't sound like a guy who thinks there's a financial crisis right around the corner. Here, August 2007, title of the newsletter, "The 2 Ways You'll Get Rich Investing in 2007. All right, how do you get rich? He recommends telecom stocks, several different telecom stocks, including one of them that happened to be in Taiwan. Okay, August 2007. October 2007, title of his newsletter, "The Only Hedge Fund You Should Buy. Markel Corporation, symbol MKL, stock, it's at $540 a share, $540. Here's Markel. Although Markel is still primarily an insurance company, it has actually become a hedge fund in all but name. The company is leveraged. It invests in quantitative speculations, insurance, and funnels the proceeds into an ever-growing asset base." So here it is, October of 2007. He's recommending a leveraged financial. The stock was at $540 a share. It fell down to $200 in March of 2009 by better than 60%. But would a guy who was worried about a financial crisis as early as 2006 be recommending to his subscribers that they buy a leveraged financial as late as October of 2007. In fact, as of October of 2007, he didn't have a single short recommendation in his portfolio. It was all long. Now let's go forward. November of 2007 got a little interesting because I read an article that piqued my interest. The title, What You Need to Know to Profit from the Collapse in the Housing Market. Oh, the collapse of the housing market. He's warning about a collapse. No, he's not warning about a collapse. He's telling you what to do because it's already collapsed. He thinks it's bottomed out, and he's recommending a home builder. I'm going to read the quote from November 2007. If you want to be a great investor, you have to buy good companies when their prices are exceptionally attractive. You can only get that chance with the best companies in the midst of a crisis. As an analyst, the collapse of the home building sector is a wonderful challenge. He says, one company that stands head and shoulders above the rest is NVR. He recommends buying it. It's at $450. Now, to his credit, that stock didn't get beat up as much as a lot of other home buyers that he didn't recommend, but it still went down to $350 in March of 2009. But if Porter really thought there was a financial crisis coming, if he really thought Fannie and Freddie were going to go bankrupt in 2006, like he claimed, if he was really warning people to avoid financials, why would he recommend a home builder in November of 2007? Why would he tell his readers to buy a home builder in November of 2007 if he thought that financial crisis was coming in 2008? Of course he wouldn't. So December 2007, you have no clue that he is worried about anything. He has no short positions, all long positions, mostly blue chip, multinational stocks, nothing gold and silver. Not that gold and silver did well in 2008, but it would be indicative that he thought that there was a problem. Nothing. Classic, big cap stocks, just like everybody else would own. Now, he writes an article in 2008, Lusting for a Bear. Okay, this is in April of 2008. I mean, it's already April of 2008. Maybe this is it. Maybe this is where he's going to predict something. What does he do in April 2008? This is where he puts on one short position, only one, Capital One. All right, and that is a financial, and that was a good call to short Capital One. In that same issue, he also recommended buying another long, WellPoint, which was an HMO. So here it is, April of 2008. He finally has one short position, but he doesn't tell his people to sell their other 22 long positions. They don't buy any puts. They don't do anything. And remember, included in those 22 stocks that are long is a home builder. So he's short one financial, long a home builder, and then he's got 21 other stocks that he is long. So he is better than 90% long. No indication of any concern, of any worries about a financial crisis. It's already April of 2008. In fact, Bear Stearns went bankrupt, I think, in March of 2008. So Bear Stearns has already gone bankrupt, and he still doesn't think there's a crisis coming. Now, the first time he actually says something that gives him a little credibility is in June of 2008. This is June. This is 2 months before it hit the fan. He has a newsletter titled Freddie Mac and Fannie Mae are going to zero. That was a good call. He got that right. Now, granted, they had already dropped 70% before he made that call. It was 3 months after Bear Stearns had gone bankrupt. We already had the subprime problem fully out there. All right, so it wasn't like he forecasted in advance. Remember, just a few months earlier, he was recommending buying a home builder, because he had no idea that this was going to happen. But in June of 2008, he came to the conclusion that Freddie and Fannie would go bankrupt. And he was right. And he recommended shorting them. Now, that's all he did. So now his portfolio has 23 long positions and 3 short positions. Fannie and Freddie and that one bank. That's it. Now, he's almost 90% long and barely, and he's only a little bit short. He's 10% short, 12% short, 88% long. And this is in June of 2008, right? Very, very close to the beginning of the financial crisis. Hardly sound like a guy that thinks there's a real crisis coming. Yes, he's bearish on Fannie and Freddie, but that's it. He's not bearish on anything else. He's not bearish on the U.S. economy or the market. He's not telling people to sell their stocks. He's not telling people to buy puts. He's not, nothing. That's it. And yes, his clients or his subscribers did benefit on their shorts, but the problem was they lost a lot on their longs. He did not make a big all-in kind of bet. It was a very small portion of his portfolio that was short. Now, let's go to July of 2008. Very, very close to the meltdown. Here is his newsletter for July of 2008. How to significantly increase your net worth in the midst of a financial collapse, right? So he thinks there's a financial collapse. It's already happening, but he hasn't told anybody to sell their stocks or buy gold or silver yet. He finally says in July of 2008, buy gold and silver, GLD and SLV, and he adds them to the portfolio. That's it. Now, of course, gold and silver ended up, those ETFs also went down in 2008. I know, I was in gold and silver. So he added gold and silver to his portfolio, but that's it. No other shorts, no puts, nothing. Now, here's one of the most amazing things. This is August of 2008. August 2008. The bottom is about to drop out of the market. This is the real financial crisis beginning that he claims he predicted. Here's the title of that newsletter. How to make 20 times your money in the next 5 years. All right, well, how to make 20 times your money? Well, you'd think it's some kind of big short. I don't know. But here's what he says. I recommend you buy shares of MBIA for less than $10. MBIA is a major financial, a bank. This is in August of 2008. And he recommends a 25% stop loss, which is good because the stock basically within 3 months, the stock was down 50%. And by the end of the financial crisis, it had dropped all the way down, I think, to $3 or $2. It had dropped, went to $2. So this by March of 2009, not too long after he recommended it had dropped by 80%. But he got stopped out when it fell by 25%. But here is my point. Here we are weeks away from the financial crisis. He's recommending a financial, buy a financial in August 2008. Does that sound like a guy that thinks there's a financial crisis coming right around the corner, telling his readers to go buy a financial that ultimately goes down by 80%? November 2008, clearly maybe towards the end of the financial crisis. Here's what he says. The first thing I want you to do this month, and do it right now, is buy a large stake in an Alley Capital Management, right? They're a mortgage portfolio, right? A mortgage portfolio. Now, yes, that stock is up since you recommended it a little bit, maybe 30%, but still doesn't show. This is late November. Now, get this. In December of 2008, he finally adds gold stocks to his portfolio. He does add one ETF but he also shorts, for the first time, shorts a home builder. December 2008, he shorts DHI at $7.50. It's now at $11.50. In fact, it went up. So the only time he shorted a home builder or recommended shorting a home builder was after they had collapsed. December of 2008, he shorted near the lows. That's it. So here's the guy that claims that he predicted the financial crisis of 2008 more accurately than anybody else, any other firm he knows, that he had his clients avoid all the losses associated with the collapse of 2008 and even profited from what happened in 2008. Here is what he was recommending as late as August of 2008. August of 2008, his recommended portfolio to his paid subscribers had 26 total positions, of which only 3 were shorts. Now, to his credit, they were all financials, and 2 of them were Freddie and Fannie. But he was not totally bearish on financials because 2 of the 23 stocks that were long were Moody's and MBIA. And he specifically wrote an asterisk in his newsletter. The reason he was recommending those 2 stocks is because he said it was a good way to play the rebound in financials. So here we are, right, within a month of the bankruptcy of Lehman Brothers, the bankruptcy of Merrill Lynch, the bankruptcy of AIG, and Porter Stansberry is telling his paid subscribers that he thinks financials are ready to rebound. They haven't even collapsed yet. Now, they have gone down from their highs, and he thinks it's over. And despite the fact that Porter correctly believes that Fannie and Freddie are going bankrupt, he does not understand the broader implications of their bankruptcy on the overall stock market, economy, on the financials. And as I said earlier, if Porter wants to come on this show and try to convince me or make an argument that he saw this coming, that he has any other proof, because if he saw it coming, he certainly didn't recommend that his readers do anything in their portfolio. Yes, he recommended that they short Freddie and Fannie, but that was less than 10% of their portfolio. The rest of their portfolio went down, not up. So, yes, it mitigated the losses, but they didn't avoid the losses. And anyway, and I saw nothing else in there about him telling people to avoid any of the other stocks that he claims to have had advised people to avoid.